started. Hi, good evening, everyone. Thank you all for joining us for this webinar. I'm Saket Kumar, co-founder at ETF Junction. Let me share a brief on ETF Junction. I'm sure you must have been hearing the name. ETF Junction is a fintech platform which intends to provide a complete ecosystem for the ETF industry, which involves manufacturer, ETF service provider like stockbroker, investment advisors, influencers, and above all the investors clearly. In India. So that's something which we are making an effort. The endeavor is also to solve the underlying challenges which the ETF industry is seeing, like lack of awareness, proper infrastructure in the country. So endeavor is being made in that direction. It's a pleasure to welcome you all to this thought-provoking session on passive and active investing. This has been presented by ETF Pathshaala. So just to give you, like to share that ETF Pathshaala is just a forum for sharing valuable insights on ETF passive investing from the industry experts. We have some, and we've been having this an eminent speaker from the field of passive investing. This is being conducted on a regular basis every month, 3 or 4 sessions, which has been really thanks to your larger participation and increasing participation. Now, coming directly to today's topic of the webinar, is it a debate, active and passive investing? We embark on a journey to demystify the debate, right, between active and passive investing. It's not about choosing one over the other, but it is about harnessing the potential and the power each of these have, right, in our investment portfolio. So that's where we would be looking at it, right? Now, if you look at in the dynamic landscape of Indian investing, since 2001, if you remember, the AUM of the active industry, which is the mutual fund at this point in time we talk about, was hardly 1 lakh crore approximately. In a 23-year period has moved up to almost 47 lakh crore. Now, this is where we see that the active has really flourished. But now we turn our attention to the newer frontier, passive investing. And today, just not about dispelling myths and wrong belief about passive, but it's also about empowering the entire participants and all of us who are watching this about the knowledge on the same, right? Without further ado, let me just introduce you to the eminent panelists we have for today's webinar. We have Mr. Vishal Jain, the CEO of Zerodha Asset Management Private Limited. I would just like to add that Vishal has been there since 2001, one of the few people, and rightly so, he's being touted as the June Bugle of Indian industry, right? Someone who has seen it all from benchmark to Nippon and right now in Zerodha. So I think you can see on the screen what all has he covered over the years. Yeah, the next
week. Happy to be part of this time.
Thank you. Next one is Vishal Dhawan. Someone who is really a forefront of the entire RIA movement. I think he's been leading the pack in terms of taking that entire initiative despite so much of obstacle which has come in recent times, which we all have been hearing and reading about. So here is Mr. Vishal Dhawan and his entire journey. He's the founder and CEO of Plan Ahead Wealth Advisor.
Thanks, Saket, for having me over.
Thanks, Vishal. Last, we have Koel, our own from ETF Junction. He heads strategic investment right at ETF Junction. Just to share that Koel is again one force which has been very, very rare if you take the number of years which is spent in passives, right? Being all across different industry, different companies. So it's great to hear from her the insight on passive and also ETF. I'm sure the collective expertise promises to illuminate the path of all of us on the realm of active and passive investing, which we are going to, just dwell on today. So would request all the participants to keep sharing any question which comes up, right? Obviously, they have to be taken from these luminaries which we have in today's session, right? The same will be answered once we complete this entire, discussion at the end by, each of them if you want to be covered by either of the three, right? So I think, we'll just start with Koel. Koel, if you see, India has had a good habit. Indians have a good habit of saving. And if you look at an average, Indians been saving 30 to 35%, which if you look at globally, it's 25%. So better than, average. Now, if you look at, there has been a tectonic shift, right, which has happened. Historically, Indians are known for investing in physical assets, which is gold and real estate. For your surprise, in last 5 years, things have dramatically changed. Last 5 years, it was 55%, the physical assets, 45% was financial assets. Thanks to COVID and other efforts by, I think the existing regime of, digitization or opening of account and all that, demat, things have started moving in the very positive in our direction. Now it stands at 55% financial assets, 45% is your, physical assets. That's a big shift very soon, right? But we clearly see there's a growth, it is reflected in the demat account, which is roughly around 12 crore plus now. Also mutual fund, I think in September hit 4 crore, right? So clearly shows that the numbers are reflected there. Well, I think the existing participant would like to understand, can you briefly explain for them the core principles of active and passive investing for our audience to set the stage for our discussion today? And also,
thanks.
what is making passive investing more popular globally? Go ahead.
Yeah, thanks, Saket. I think that was a good, introduction into, how the investment space is growing. And in the, interest of that we have a very varied audience here, not necessarily that everybody is very, very, thorough or understands the financial space a lot. I'm going to make it very, very simple when, we're trying to use the words active and passive. I think it's something that is being spoken about, a lot in the financial space, to the extent that probably it's something people are bored of hearing, but still there's people who ask what is active, what is passive. So let's explain it with a very, very simple example. Diwali just went by, and let's try to draw an analogy with mithai boxes and active and passive. Okay, so let's see now. An active strategy would be if you go to your mithai dukan, your chandu halwai or whatever, and you select your box of mithai by your choice. So your aunt and uncle say doesn't like kaju katli, so that usko bundi ka laddu denge. Then we'll give him something like cham cham, or maybe some kind of somebody's very, very conscious about health, etc. So you give them dry fruits oriented, and you mix your dry fruits in that box. So that is, you have actively selected those things. So that becomes your active investment. So typically, if somebody is actively going and selecting stocks in the market, mutual fund managers go and select based on the basis of research. That's your active. Now let's come to the passive and the Diwali mithai box. Now Chandu Halwais and the rest of the lot, they have their preset boxes. Or you go to one of these stores, the Diwali ke time bahut sara aise stores aa jate hain where you have preset boxes, little bit of dry fruits, little bit of mithai, little bit of chocolates. There you go, your passive investing. So passive investing is nothing but which is based on an index. An index is nothing where there is an index provider who decides the mix of what are the stocks that are going to be there. Based on that, the mutual fund or the fund manager will decide to pick that entire basket in the exact same mix as that indexes. So that's called your index investing. So very simple ho gaya, active and passive. Now let's talk about the advantages of active and passive, right? One is, of course, you have your own choice, apni choice ki mithai, aunt ki choice ki mithai. So you know which ones you are picking, and you have your preferences. So that's the advantages in active. In a passive, what the advantages have come to think, especially in terms of investing, is they are typically low cost. They have a kind of a diversified basket. So it is kind of, you have different bits and pieces. Like, in your mithai box, you can get dry fruits, you can get a little bit of mithai, you can get a little bit of chocolates. So you have a nice mix that you can get. And then simply, it's very, very simple. So, you don't have to go and, worry about, okay, do I have to understand the stock, how it's performing, what is its fundamentals, is the company going to do well in the future? You have an index which has got its defined, like something like a Sensex or a Nifty. You know that it is the benchmark for the country, and it defines how the countries and the large cap space is growing out, right? So that's how you are selecting. Supposing you take an auto index or auto product ETF, right? So then you know that you're getting into the auto segment. You don't have to think, okay, now I'll pick 1, 2, 3, because there's a very efficient and proficient index provider behind who has created that index with no bias on his own. So these are the advantages that you have in a very simplistic form, explaining active and passive. Now, to the next question, Saket, which you said, why is passive growing more globally? Now, I think the reason is the same. It's cost effective. It is very simple. You have a diversified basket. So instead of, over investing in one stock or overweighted in one stock, you have a plethora of stocks within one, and you're getting a different flavor of different sectors, etc., which are forming into one index, right? Today, global assets have increased. So the global market today is around $10 trillion with over 11,000 products. But this was not the same. It took almost 10 years for it to reach its first milestone. But then the successive trillions kept coming in very, very short spans of time, right? So that's what's triggering the entire, not only global, but the local markets as well. One thing I want to really address here, while we're talking about active, while we are talking about passive, I want to also address human behavior, right? I've been talking to a lot of people. Incidentally, we launched this platform called Her Money Junction, which is actually focused towards women, but it's given me a chance to talk to a lot of individual people and their approach towards investment. And everybody is treats it like a lottery ticket. They want a 10 rupees to become 1,000 or 10,000. Now, if you're going to treat it with that perspective, I think that's when all the worries and the difficulties come to your path. Index based investing, or passive investing, is a very disciplined and kind of a good way to approach growing your wealth in a very, very time based factor, right? So one of the SEBI research, I mean, recently, I think today in one of the newspapers, the SEBI chief has kind of said that there's an average loss that is incurred by 89% of investors in FNO. So, that yet people jump to FNO, they want to make these skyrocketing profits, etc. But that same report says that minority of the investors who actually made saw an average profit of only 1.5 lakhs. So, is this the space you're going to be? And this is that only around 11% of the individual traders. Then you have trading costs, etc. So when you're going the active route, you have to be very mindful is what is the active route you're taking. And also when you're going in the passive route, you have to be patient enough and you have to see the merits of what the passive offers. Obviously, the two in tandem work well, but it's how you want to make the choice, and that choice towards investing your own behavior to see your wealth grow slowly and steadily. Thanks, Saket.
Thanks, Koel. I think beautifully put in with such a lucid example. I must say that going forward, I'm sure all the participants would remember that Active is picking from, Chandu Halwai, your own assorted pack. And, if that is Active, and, if he is providing a pack which is already assorted by him, right, for everyone to pick up, that's passive. That's great. Now, the next question is with Mr. Vishal Jain. I think if you look at the recent CRISIL report, right, it is talking about that the active saving in India, right, is really adding up. As we just saw, take that story forward, they are forecasting that the growth of the managed asset, when I say managed assets, it is mutual fund, insurance, PMS, alternative investments, put together at this point in time is roughly 1.35 trillion, which is 135 crore. And they have really galloped, right? Since last 4 years, from 2019, March have, I think from 63 lakh crore, it has gone up to 135 lakh crore. So this is where I think the larger contribution has come from insurance company, 20 lakh crore, and mutual fund, 20 lakh crore. Now that is just one. When you look forward, it is expected to go up to 3.15 trillion, which is 315 lakh crore. That's the kind of size, which will be there. Clearly, I think I've been hearing a lot of videos of Vishal Jain and talking about, what is most important in this country of 144 crore people and still 4 crore investing in mutual fund, that, products have not been simple. Simplicity is something which need to be, given to them. And that's, I believe, Zerodha is really spearheading that entire initiative to make things easier for investors to really add up. I've not spoken about the total number, roughly 144, how much 4 crore will add up to, but the expected forecast by CRISIL talks about 315 lakh crore. Vishal, the fact that, a lot of new millennial people are adding up, right? Now they need to understand, between active and passive, that itself is a larger piece to understand. What are the basic misconceptions and myths, right, which is there about active and passive investing? And is it fair to view active and passive as either or strategy of investing? Vishal Jain.
So Thanks, Saket, and thanks for the lovely example also, Goel. I think, see, the biggest myth is not about active or passive. I think the biggest myth is about investing. I think most of the times people feel that they need to keep doing something more to generate extra returns. And I think that's where people end up trading more. People end up listening to a lot of noise that happens in the market all the time, whether it may be news channels, whether it may be newspapers, whether it may be friends. That I need to keep doing something more to keep earning that extra return. I don't think that's necessary. I think very simple strategies also can and possibly they'll achieve better results than somebody sitting there all the time and trying to time the market, trying to find the right stock, trying to find the right sector, trying to find the right fund manager, trying to find the right scheme. In that whole quest of beating the market, of looking for alpha all the time, we end up losing the simple beta of the market, right? And I think it's important that people focus on, at least getting the market returns, because when you look at a country like India, which is one of the best growth economies, an example of a very good growth economy in the world, um, a simple buy and hold strategy can also help you achieve, achieve good results. And I think that's what investors, should focus on. It's not a question of active or passive. It's a matter of, I think, being disciplined in the way you're investing and basically simplifying the way you invest. Taking just a step ahead from also what Koel said, one of the important things about passive and why passive, investing has gained traction over the world is that remember one thing, it's passive basically brings out the collective wisdom of the markets, right? And when I mean collective wisdom of the markets, I mean today, I'm not sure what, say, a company like Reliance Industry is trading. I think it must be trading at whatever 2,300, 2,400 or so. Today, whatever price it's trading at, it's because that's the collective wisdom of the market. So today, at that given point of time, that's the information that the entire market believes is there about the company, and therefore that is the valuation of the company, and that's the collective wisdom of the markets, and therefore all the brains and all the people in the market, that includes me, you, people who are trading in the market, believe that that's the price of the stock at that point of time. And therefore, most of us, I mean, we have to understand that the market is much larger than all of us, right? And therefore, to consistently keep beating the market is a difficult one. I mean, imagine day in and day out, you have to keep beating the market, finding the right stock, finding the right fund manager, finding the right scheme. It's physically impossible to do it. And therefore, a simple way is what you said, is to use both strategies. And one way to use both strategies is use that simple, as I keep telling people, is that use that core and satellite kind of approach, where the core becomes a market and the satellite becomes a place where you can do a lot of these alternate strategies depending on your needs, your financial needs, your risk taking ability. You can define how you want to split that ratio between a core and satellite.
Thank you, Vishaljan. I think beautifully explained, what are the advantages of having both in your portfolio and how they are different. Thanks. Thank you so much. Coming to Vishal Dhawan, if you look at investing decision, right? Investing decision or investment decision rest on three legs: safety, liquidity, and return. Now, investor at large should be well equipped to measure the performance of any instrument which they are investing in. My question to Vishal Dhawan is that how should investor evaluate the performance of actively managed fund compared to passive ones? Because as such, both are they really different in what manner one should look at, and are there specific market conditions, right, which where active management tends to outperform the passive ones? Are there any instances historically you'd like to share? Vishal Dhawan, please.
So it's a very good question, because what happens is there are lots of beliefs around, when one thing does better and when another thing does better between active and passive. And one of the things that we see most commonly come out is कि ये सब जो ज्ञान है ना, वो internationally true है कि active actually underperforms passive. But when you come to India, this is not true. And it's very surprising that the data over the years has clearly demonstrated that portfolios need to have both active and passive, because a very large number of active strategies actually underperform passive. Now, I think the question really to answer is, how do I even decide what's a good fund to buy into? And therefore, I have to be able to do some sort of a comparison. The most common comparison that we come across from investors is that they look at the past point-to-point returns or trading returns, saying in the last 1 year, for example, this fund has delivered X percentage. This other fund has delivered X plus 1%. Some other fund has delivered X minus 1%. And therefore, they tend to buy logically that which has delivered an X plus 1% because they assume that this will continue out in the future as well. The statistically right method to actually go and look at data is to do rolling returns rather than doing point-to-point returns. So one of the things that every investor should be encouraged to do, and obviously there are now platforms which do this as well for you, is try to ensure that you look at data on a rolling basis, which means the base year of what you're looking at in data is not influencing the outcome. For example, if you look at small caps, right, which are the most popular segment at this particular point, and there's lots of conversation happening around how well small caps have done. If you look at the last 3-year returns, you might find that the CAGR is 35% over the last 3 years. But if you roll this data over multiple 3-year timeframes, suddenly that return is nowhere close to 35% a year. It's much, much, much lower. And in fact, it may be lower than what you get from large companies itself. And therefore, I think data can make you make wrong decisions very often. So therefore, it's important to look at the data correctly when you're evaluating actives versus passives. The second thing which both Koel and Vishal alluded to is obviously expenses. And even if an active manager outperforms a passive manager, if the passive manager is significantly cheaper, and therefore when you add the fee component on top of the outperformance, you might find that on a net basis, your passive fund has actually outperformed the active fund. So it's important to look at both returns as well as fees correctly, because that's the net outcome that you will end up getting as an investor.
Thanks, Vishal.
Maybe I'll just add to the third question that you raised around specific market conditions where active management might have outperformed. So I think for every investor in equities, I think most of them worry about downside, right? I think if you make money on equities, I suspect that the passive versus active debate is not such a big debate in the mind of everyone, because then what everyone does is they start to say that, my alternate instrument was a fixed deposit or something else. I made a lot of money. Now, maybe in something I made 18%, in something else I made 16%, and something else I made 17%. I don't think it worries people too much. But when downsides happen, it obviously starts to worry, because no one likes to see money getting lost, even if they know that it may be temporary. And what tends to happen is the most common thing that we hear out from people is that if there is downsides, active managers are better positioned to take advantage. This is what we hear. And therefore, because everyone talks about this, we also tend to believe it. So what we went back and did is looked at the last 5-6 instances over the last 20 years when markets have actually fallen, to see whether, when markets fell and they came back, was it sensible to have been in an active fund over a passive fund? And the data was very interesting that more often than not, right, on the large cap side, actually being in passives actually led to an outperformance of close to about 2% a year when markets actually fell and recovered, which meant that you were much better off being in passives than in active. Similarly, on the mid-cap side, one would have imagined that, mid-cap managers, actively managed, would have done much better as compared to what a passive index tracking mechanism would have done. But again, you saw that there was actually no difference between the outperformance or underperformance between active and passive on the mid-cap side. The only place where this actually helped was on the small cap side, where small caps actually outperformed, active small cap managers outperformed passive small cap managers roughly by about 5% during that period of time. So very clearly, what you will find is that a lot of the debates that happen between active and passive, what works when, where, etc., may not be backed by data when you actually get to the data. So very strongly, I would recommend everyone that whenever you're
Hello. Hello. Thanks, Vishal. I think beautifully put in the insight in
make what you've said, how.
Hello.
I think you can continue, Saket.
Yeah, there's some issue out there, clearly. Anyway, we'll just take it up. I think just to take this forward, very well explained, and also the instances from the Indian market on what has happened on both when the market is corrected and market is went up, beautifully put in. Thank you, Vishal Dhawan there. I'll just move to the next question. Clearly, if you look at besides simplicity, the diversification and other aspects, cost is something which has really taken the ETF, entire impetus to a different level, globally. And as I think Koil also was sharing that, from a small number, and it's almost doubled every 5 years. That's what is global growth happening. Even as we talk about, USA has got total in mutual fund 54%, in the passives, and active having 46%. So that is how things have been. And how much time? Just 30 years. This entire passive investing theme started in 30 years back. That's where it is. Now, when we look at, I think cost effectiveness is one thing which is really moving up. Just to give you a sense that, it really gathered pace when there was a 2008 fiasco, and globally every investor start questioning the cost and all, and that's where this particular instrument took the huge impetus and grown. The question to Vishal Jain, could you shed light, shed light on the cost difference between active and passive investing, and how these impact investors' return? That's one. Second, are there hidden costs that investors should be aware of in both approaches? Vishal Jain.
I think the important thing gets covered in total expense ratio in the TER of the scheme, right? Typically in active schemes, a direct scheme, an active direct scheme would cost between 1 to 1.25%. Passive schemes range between, I think, 0.05% to 0.3%, right? So you end up gaining about 0.75 to 1% over there. In a regular scheme, active schemes charge all the way up to, I think, 2.25%. Whereas I think there's a cap on passive schemes of 1%. So typically you end up an investor lands up saving about 0.75 to 1% a year on expense itself, when you look at the total expense ratio. And I think that's the main number to look at. I mean, at the end of the day, everything gets captured in the NAV, right? And the NAV is a final number which is net of total expense ratio and other charges which are there in the scheme. So whether it's active or passive, there are no hidden costs in that sense. But I think the final NAV is what everyone should look at.
Thank you. Thank you, Vishal Jain. I think I'll just take this liberty, Vishal, now that you are here. And as I said that, India has John Bogle, someone who has been there since, 2001 onwards. What change, Vishal, you see there? How has this entire journey shaped up? And where do you see things moving up? From your personal experience, if you can say for all our audience, why?
I mean, I think it's been very encouraging, especially in the last 4 to 5 years. I think I would say there have been two triggers in the market, somewhere around 2017, 2018, and, both those triggers were regulatory. I think post that a lot changed. So one of the regulations which changed was that at one point of time, most schemes were benchmarking themselves with the price index, And I think SEBI came and changed that and said that all schemes have to now benchmark versus the total returns index. Now, for the people who are here, the difference basically is that what you see on television as the index is the price index. And when you look at the index with dividends, that's called as a total returns index. Now, something like a Nifty index, the difference between the two is basically the dividend yield. That's the dividend that you earn from the underlying companies that are there. Now, the dividend yield itself is about 1 to 1.25% or so. And for when you look at mid caps and small caps, it might slightly be a little higher. And that difference of 1.25% was being shown as alpha, which was being generated by active schemes, which was always wrong in that sense. So that's one thing that got corrected. The second thing that happened also was the scheme categorization that SEBI brought in somewhere in 2018 or so. And the reason why the categorization was brought in is because you found a lot of these large cap schemes having nearly 25 to 35% in mid caps and then benchmarking themselves versus the large cap. Right. And I think that's where the performance gap was coming, where because of the extra exposure that was being taken in mid caps, I mean, when the markets went up, you got that extra kicker from there. And SEBI, kind of said then that, these 100 companies are large cap. From 101 to 250, this become mid cap. From 251 to 500, those are small cap companies. And post that is a micro cap category that is there. And everyone had to follow that. Even at this point of time, fund managers still have a leeway. So if you have a large cap scheme, you still have a leeway of having about 20% mid cap. So the leeway is still there in that sense. And I think these two factors, led to, people then asking questions in terms of when the data started coming out after a year or so. It showed that a majority of the schemes are side underperforming the index. And this data was always there. I mean, when you looked at the SPIVA data all the way from, even 2003, 2004 in India, that data always showed that the majority of the active schemes were underperforming at that point as well. It's only that the data has become more apparent now, and people are starting to realize and question that, look, what's the point of paying such a high expense ratio when there is no guarantee of outperformance? I think these were two triggers in 2018 which kind of changed the path of passive products and led to a lot of traction coming in, into ETFs and index funds. And that is gaining ground, as we're moving ahead.
Thank
Yeah,
you
and
so
I
much.
think thanks, Ankit. And I'll just add here. I think adding to what Vishal said, I think there was another change that happened where, additional to categorization, the benchmarking was also streamlined. So large caps could earlier be benchmarking to different indices. So I think then the large cap segment was then streamlined to be aligned to the segment or the index which was aligned to the large cap space, small cap, mid cap similarly. So that actually narrowed down the comparatives even more. And I think that's, kind of adding to what Vishal said, that kind of started shrinking the alpha that was showing, but that was being shown by the actives a lot more. So I think that started bringing that up, and now there are more and more studies. PIVA was the beginning of what started, of showing how actives were underperforming the index. But now today you have a lot of other studies who are also coming up and showing that it's not only in the large cap, but even in the mid cap, slowly and steadily, active space is not able to kind of outbeat all of it. So there are more percentages of passives that are doing better than the actives.
Yeah. Thank you, Vishal Jain. I think clearly reflecting that, the level playing field by SEBI, where TR being now taking everything into factor, has really made a difference. And, we are really seeing that has helped the entire industry. And I'm sure as we progress, it will really add up. With that, I think we'll move to Coel. Coel, I think, if you look at passive innovation from active, right? What we had a basic mutual fund, innovation is the order of the day, clearly, and, if you look at globally, why things are moving up last, I think 1 year, global market has seen huge impetus because of factor investing. Momentum is really, spearheading this entire growth chart, right? So just to ask from you, that ETF has seen innovations beyond traditional market cap weightage index. And though we have some in India, not yet to come, how does this impact the active passive debate? That's one. Second, from you is that, are there any specific niche area where active managed ETFs are gaining tractions, right? Go ahead.
Yeah, thanks. And a very, I think advanced question in terms of, and we're looking a bit into the futuristic from an India perspective, but maybe we always, from India, I think we keep jumping a lot of guns and we kind of get there ahead. But if you look at today, a lot of, what is trending rather in the global space, when we were just at market-based return index, etc., we saw a lot of smart beta indices. So a lot of people out there may be saying, what is smart beta? It's nothing but indexes or products which are giving you maybe higher returns than your standard market returns, right? So those are the kind of smart beta. So they are factor based, which means that rather than just a market cap weighted index, you're going with basically the way an active fund manager would select based on some fundamental criteria. You input those fundamental criteria into a formula based and do that selection of those indices, and that index base will then become your product selection by a product provider who will then launch your ETF. So that becomes a non-traditional kind of a passive product. Now, if I'm looking at global products and global ETFs, I think they have reached kind of gone really far ahead. There's, of course, sustainability, or what we call as ESG, environment, social, and corporate governance oriented indices. A lot on the European side that is gaining a lot of traction. Within India, like I said, in India, I think it's still a bit of the more market-based return indices and sectoral indices that are doing well. But if you look at what themes today are doing well or upcoming trends in 2023, there is artificial intelligence and genomics. So, there are big pharma companies who are investing in AI, and, they're kind of powering drug discovery. There are pharmaceutical companies who are really working with all these artificial intelligence and, integrating that to kind of create more commercial development. So these are the kind of companies that are coming up, and these are the kind of themes then that are getting inputted into ETFs. Then you have lithium and electric vehicles. We have a few cases here in India where you have such ETFs that have kind of made their way in, or at least passive products that are making their way in. But this is another electric EV is a big space, rather electric vehicles, where that seems to be a futuristic proposition which could lead to more investments coming into that space. Another thing, when we are talking about artificial intelligence, there's the metaverse. So there are big tech, artificial intelligence transformations that are happening. Amazon has invested almost up to 4 billion in Anthropic, which is an AI startup renowned for its Claude chatbox. Now, this is, of course, similar to ChatGPT and Google's Bard, but it intends to excel in translation, code generation, and also answering queries. So you are coming up with the next gen kind of products as well. Millennials are getting into the space. So there are products that are, and ETFs that are kind of building in for the millennial consumers. Defense technology today, we know how the world is growing, how there are not so pleasant wars, etc., that are happening. But that defense technology is then companies are building up. So the contracts getting signed to modernize military segments. So these are again another theme that are emerging among passive. Another one is emerging markets and e-commerce and fintech. And of course, you can't keep India away from that space, right? Because the e-commerce value today is set to increase at a compounded annual growth rate of 28%, from 2.8 trillion rupees to almost 9.7 trillion rupees. That's the kind of growth that's happened from 2018 to 2023. And this has been driven by rising in internet, smartphone penetration, faster delivery options on online retailers. Amazon has been growing a lot. There's a growing consumer preference on online shopping, and COVID has really fueled all of that. So if you look at that aspect, there is also a lot happening. If you look at Indian markets, I think what is slowly and steadily gaining ground is smart beta. I think you have products which are kind of factor based, which are doing very well. So those are the kind of ones which are getting and gathering a lot of assets of late, and then they're slowly and steadily gaining pace. You have quality, you have momentum, and you have a lot of these other newer factors that are coming up, and that Indian consumers and Indian investors are kind of liking. But also you spoke about active ETFs, Saket. Now, active ETFs is a space that is really, really gaining a lot of ground globally. In fact, in Canada, the AUMs have soared between 2018 and 21, and they continue to grow into 2023. In US, the growth has been across product category. So we have also been noticing a lot of mutual funds are converting their mutual funds into ETFs. That has also been happening. Now, active ETFs have actually been at least, been growing at the rate of 30%. And around the end of October, they almost were around 440 odd more billion dollars in assets. So it's almost tripled from what it was in 2020. So investors have actually left actively managed mutual funds in the US because it suffered a lot of outflows in the last 7 out of the 8 calendar years, including it was a record 1 trillion in 2022. So this seems to suggest that active management, at least in the US and the West, seems to be growing out of style, and active ETFs are thriving. But given the context of what we are talking today, the ETFs per se, their advantages of low cost, liquidity, transparency is something that is really fueling the market, not only in the West but also for Indian markets. And I think all these new trends that are coming up globally, I feel it's just a matter of time that it will come into India as well, as soon as investor awareness to understand that instead of trying to try your luck and trying to make that, again I'll repeat, in terms of that quick money and trying to create a lot of exponential wealth in a very short time. I think that's what's probably holding back a lot of people from making those disciplined investments. You can just do SIPs and you can really build your wealth over a period of time, and the power of compounding, etc., is something that is so powerful that once you start investing, even with the smallest denomination, but continue it and do it in a disciplined manner, it has a long way to go.
Well said, Koel. But just before I just peep into Vishal, Dhawan, on the next question, for all the participants who are here, I think for ETF Junction has been spearheading in taking the awareness and education on ETF and entire passive world forward. I think from our ETF Junction, we have started something, Her Money Junction, which is being led by Koel. And recently we had the first webinar where Monica Hallen was, the keynote speaker. Can you just share something, what was the takeaway from that, Koel?
Yeah, sure. So I think, one of the reasons Her Money Junction was, I think, born was throughout my 20 years of experience, and and the interactions that I'm having both at a professional and personal level, I always felt that there were always a lot of unsaid conversations where the word finance would always kind of create a little bit of a hesitation, and especially among the women investors, saying that, oh, this is not my zone. I think this is something I wanted to start bringing into Her Money Junction in terms of conversations of people who are there, confident, people like Monica Halal. There was Lakshmi Iyer, Jyoti and Hansi as well, who shared their personal experience. I think one thing that came out very clear was that everybody needs to take charge of their own finances. They all went through their own personal journeys. I think what was beautiful about that session and that launch, and I'd love to share with the audience if they should be going back and seeing the replay that will be posted soon, is that they've each shared the importance of why one should be managing their own finances. And actually, this is not only relevant for just the women out there, it's relevant for everybody. And I think what happens is there's a lot of today's I think thought process which says whatever you earn today, you spend it out, which is great. But if you can keep that 1,000 or 2,000 rupees that you are going to spend on a coffee or a meal, and just put it in something like a systematic investment plan, you are thinking in a long time, and the sooner you start, the better it is. So
Thanks,
I think it is very, very important to have financial independence, and I think that's what came out.
Thank you so much for that insight. Vishal, if you look at Vishal Dhawan, I mean, if you look at, the investment horizon, when you take the, compounding formula 1 plus, PR upon 100 to the power, and time is very critical, right? The larger, and today, if we talk about Warren Buffett, because of his age, I think he really, made huge difference. Now, the one question which is very pertinent to the, listener or the participant out here is that how long and which particular instrument. So the question is that how does the time horizon of an investor influences the choice between active and passive? Is it that for short term or long term, respective strategies in which one? Are there any hidden, are there any instances where a combination of both approaches has been beneficial for an investor? Vishal Dhawan.
So there are a few things that are very important. So like you rightly said, the thing that gets forgotten very often, whether it's an ETF or whether it's an active fund, is the underlying asset class is equity. And therefore, you are going to be exposed to equity risk in either situation. And as a result of that, being short term on this instrument is really not going to work with you. So whether you're short term on an ETF or whether you're short term on a passive instrument or an active instrument or an index fund, the moment the underlying is equity, there is automatically high risk for you as an investor. So very clearly, time is a great leveler. So the longer the time frame you have, the better your outcome is likely to be. Now, what happens is the definition of long term itself varies from person to person. There are people who believe that long term is 3 years. There are people who believe long term is 5 years. If you look at equity as an asset class, you'll typically find that the definition of long term investing is 10 years plus. And therefore, you have to go out and whenever you make equity investments, have at least a 10-year investment horizon. Obviously, if you can run it for longer than that, that's even better because wealth compounding, like you mentioned, and it's a very simple sort of mathematical formula that automatically has a big impact. Now, what happens is the longer you stay invested in an instrument, the bigger the risk that you run when you pick an active manager. Because what history has shown us is that active managers have periods of extremely good performance and periods of not so great performance. And there is a very strong tendency as an investor to try to take decisions on exiting someone who's not doing well, which may be just the wrong time to exit because that may be followed by a period of large outperformance. So I think as you extend your investment horizon, which is obviously very powerful, you need to keep in mind that the risk of picking the wrong active manager actually increases rather than decreases. And therefore, as a investor, you need to be very mindful that this risk is probably best controlled by having a meaningful allocation of passives in the portfolio. Obviously, the same way that compounding benefits equity returns, cost compounding or expense compounding, the higher the expenses actually takes back from you returns. And therefore, if you're thinking longer term, you also want to be mindful that, like Vishal Jain mentioned, if the differential in cost is anywhere between 0.75% a year to say 1% or 1.25% a year, that is going to take away returns from you. So the longer your investment horizon, you also have to become more and more conscious about the expense ratio of what you're buying. And therefore, very, very importantly, do go ahead and look at passives very, very strongly if you're building a long-term equity portfolio. I think one of the best ways to look at data in terms of situations and what happens is to simplify it. And the best way to simplify is to say, okay, let's look at calendar year data to try to understand in how many calendar years, an average active fund, for example, outperforms a passive fund and vice versa. So the data is fairly interesting because if you look at the last, let's say 18 years, you will typically find that passive funds have actually outperformed, many more times than what the active funds have outperformed. The same thing happens when you get to mid caps and to actives and passives. If you see mid caps and actives and passives, you will find it's roughly equal the outperformance of one category versus another. It's only in the small cap category that if you look at calendar-wise data, that you will actually find that there has actually been a meaningful number of years where actually active has outperformed passive. And therefore, I think the longer you invest, which is very, very crucial to equity investing, the more you need to look at passives very, very seriously in your portfolio to be able to get outcomes which are safer. And I don't mean safer by saying that you will not have bad years, but safer in the sense that you will have periods where an active manager will underperform, and you will probably, as an investor, behaviorally move out at that time, and that might be, followed by outperformance. So very, very critical to combine both of these together when you're building long-term portfolios.
So good understanding. I think great insight and quelling a lot of misconception which has been there. And combination of active and passive is the way forward for any good portfolio. I'll take this question next one from Mr. Vishal Jain, right? What Vishal, if you have looked at things, especially when the active and passive investing goes, we have had a great run. We've spoken about growth happening in the industry in 2017. I'm talking about passive number from 50,000 crore to almost 8 lakh crore now. That's just one. Folios, which has gone up from 5.33 lakhs to around 1 crore plus today, from 2017 to 2023 September we were talking about. Look at the trading volume in the passives, from 2017 2,600 crore to roughly 1.3 lakh crore today. Number of ETFs almost multifold, from around 63 in 2017, this is just 5-6 year number, to almost around 200. Now, also very heartening to see that ETFs are getting the slots in the investors' portfolio, not only in the larger cities but in smaller cities as well. The question to you is that and also, since you come from a fund house which is Zerodha, which has seen the burgeoning growth, right, from scratch to a place where they have reached, I think, immaculate growth, especially in the startup world where they've placed. Where do you see the future of active and passive investing heading? Right, and this is something which is very important, especially coming from you, that consider the recent market trends and the investor preferences has been shifting. Whether we talk about new customer coming in or AUM being added, clearly passives are at the forefront. Are there any emerging strategies that investors should be keeping an eye on? Vishal Jain.
I mean, if you look at data in the US, okay, and I don't know if that's the right country to look at, because it's, in terms of development, it's far ahead. But 54% is passives, as you mentioned in the beginning, itself. And I hope India also goes that way. When I look at, India, when the same, data that you shared in terms of, even mutual fund folios, we have 4 crore folios in a population of about 140 crores or so. Right, and therefore there is still, a lot more to do over there. We have to figure out how we can get more and more people, to start using mutual fund products, to basically to define better, financial futures for themselves, right? And how do you do that? Until you don't introduce simplicity in the entire process, right from the way you invest to the kind of products that people want to invest in. I mean, you will not get more and more people. I mean, if I was to pose a question to you, or even to people who are there on this channel, I mean, today there are 50 crore PANs that have been linked to Aadhaar, right? Which means there are another 46 crore people that we need to target. We have targeted 4 crore people in the last 30 years. Right. There's still a lot more to do. And until we don't bring in simplicity into the entire process, you'll not get more and more people, starting investment journeys. And I think at this point of time, our focus as a fund house is basically how do you get these people to start investment journeys, right? Once they start investment journeys, a couple of years down the line, when they see that, this kind of investment is kind of working for them, they will then come back and ask you for more products. And that's how the entire chain starts. Right. But at this point of time, I think it's very important that, we focus on simplicity. A lot of times when I look at a lot of these even fact sheets in fund houses, I see fact sheets of 150 pages. And I don't understand, why have they made so many products? I mean, I as an investor, I mean, I get scared if I have more than 4 or 5 entries in my Demat account here. I start, feeling uncomfortable. And therefore, I think that, it's very important to bring in the simplicity aspect, in the entire process. And I think that passive, fits that bill when I look at India, uh, because of the sheer simplicity of the product. And therefore, I think if we want more and more people to start investment journeys, to start investing in mutual fund products, to benefit from the India growth story, and as Vishal said that, one must look at a 10-year horizon, then I think they should start with passive products. And then, once, you're comfortable with a simple product like a passive product, then move on to more, complex products like an active fund or a smart beta fund as Koel spoke about.
Thank Vishal Jain. I think clearly, if you look at the endeavor and effort of 144 crore population, right? And you rightly said roughly 80 crore people have smartphones, which is access to, just a moment. It takes 4-5 minutes to get KYC done and start trading in the stock market. And I think number which you shared, I'm tempted to ask this question, Vishal Jain, from you. What are the strategies which you think, right, which will take this 4.04 crore number after 63 years, right? We started mutual fund investing in 1964 from UTI. Where do you see, and what are the strategies Zerodha is adopting? Where are they really trying to get all the large customer base? If I may ask you, please.
I mean, our focus is obviously going to be on, as I said, passive, simplicity and education, because I think education goes hand in hand with adoption. So I think these are 3 things that we're going to focus on. It's still too early in the journey, but we've made a start. And, we honestly feel that this is the way for us to move ahead. We're going to be, introducing simple building blocks that investors can use, because we believe that, it's only these simple products and simple portfolios that they can make with these building blocks that will, get more and more people to start, adopting mutual fund products. And I said education is extremely important. That's one focus area that we have to work on if we have to get the next, 40-50 crore people to start investing in mutual funds.
Thank you. Thank you so much for that insight. Before I get into the last question from Mr. Vishal Dhawan, may I request all the participants to start posting the question if they have from these experts. Please feel free to write if you want to get answer from any one of these, right? So coming to the last point, I think Vishal Dhawan, I think you are the one who has been in the game of advising, right? Something which you have really excelled over the years and have a great experience out there. From an advisory standpoint, right? How do you guide clients in navigating between active and passive decisions, right, which they have to take? And what are the strategies which are effective in conveying the nuances of each approach? Vishal Dhawan.
Very clearly, I think, what we've learned is something that I mentioned earlier, that data shouts. I think, the rest of it is noise. And a lot of the noise around active and passive actually somehow takes the focus away from data. And I think what we've learned is that if we can focus on the data with investors, if we can show them the data without any biases, without any sort of, personal preference for one over the other, etc., I think investors also understand and appreciate it. And therefore, this debate then ends up not becoming an sort of active or passive debate. It becomes an and debate very clearly, where people are saying, okay, what allocation in my portfolio do I make towards active? What allocation of my portfolio do I make towards passives? What we've also seen along this journey is that there can be periods where this education needs to get reinforced. And this can happen in certain periods of time where one type of investing can outperform another type very significantly. And we've seen that happen sometimes with active managers doing really well in certain environments. And therefore, a tendency at that point for investors to want to push more towards active. And then you have to get them back to base camp and explain to them, saying that, what, this is normal. There will be cycles in which one will do better. There will be cycles in which the other will do better. We can't tilt portfolios continuously, following that cycle, because most of the times we'll get that movement wrong in that journey over 10, 15, 20 years. What is very powerful though is products like or strategies like smart beta or factor investments, I think that's an area where investors still don't fully understand, what this is about. Is this a very Western trend that is coming to India? Will it not work in India, etc.? I think that's where a lot of time for advisors like us needs to go through in terms of educating and trying to help people understand, where returns are coming from actually. If you try to break up the returns, and it no more is about beta and alpha, which is sort of more commonly talked about, but now it gets into the sources of alpha and where those might be coming from, and therefore where you might be able to find an opportunity to get that alpha, but again at a lower cost than what you would have paid to an active manager. So a lot of this is education, and I think a lot of this debate is incomplete without the other asset class, which is debt. I think one of the big shifts that has happened is debt has also become an area where there is a lot of understanding that is now coming on the fact that there is passive strategies that can work. And obviously, when pull to maturity products, etc., started to come in, or even the liquid Bs as an example, I think they really got a set of investors to come into passive strategies at a very low cost, which become a very good way for people to actually look at instruments and then take it on to the next stage where they move to other sort of options as well. So I think depending on the evolution of the investor, one may have to actually change and move your advisory approach accordingly.
Thank you. Thank you, Vishal. I think that was quite insightful. I think there's just one question. We have not much of the time to take that forward. This is basically, what are the initiatives the industry need to take from taking the existing number from 4? I think to some extent Vishal Jan has already answered, but if anyone can just take this question, that how can we reach the number from 4 crore to 40, 50, whatever it is?
Yeah, I think there's one more question, Saket, where they're saying maybe call, because that answer has been kind of answered. But we definitely want to maybe call passive as a DIY instrument. I think maybe Vishal, I did try to kind of say it's a way to begin your investing into the market journey. But I think it'll be nice for Vishal, both the Vishals, to maybe give their perspective on both, what that, maybe passive as a DIY instrument, and also, the journey from taking all those for 40 crores and so many demat accounts into, kind of channeling them into the passive space.
So DIY in the sense that I think that it's extremely important that people focus on asset allocation, right? So in that sense, I think what investors can look at is having a mix of, say, equity, debt, and commodity in their portfolios. And one way to build that kind of an asset allocation is through passive products. So you can have like a large cap, mid cap kind of a combo, with a debt ETF or a debt index fund, or in that and a gold ETF, and build a kind of risk return kind of a basket depending on what you feel. So a simple thing could be like, you could say that I'm going to have equity 50% in my portfolio, debt 25%, and gold 25%. Right now, for you to execute that kind of a strategy and keep a disciplined approach as you go ahead, is very simple for someone to do it through a passive strategy. So in that sense, I think passive strategies can be used by investors to build various kind of portfolios based on the risk and return profile. I think that's one thing that investors can look at. The second thing, in terms of what the second question was, in terms of what the industry is doing, I think a lot is changing. I think the first, I would say, MF 1.0 was when, in the last 30 years, when the entire industry focused more towards the evolved investor, which was the institution and the HNI. I think going ahead, everyone is realizing that the focus now has to be on getting more and more people to start using these products. So even at an industry level, whether it's AMFI, whether it's SEBI, I think everyone is coming together and now understanding that, look, now for the next 10 to 15 years, we need to focus on getting more and more people into the industry, into using mutual fund products, because until the financialization of the economy doesn't happen, you can just keep talking about numbers about India becoming a $10 trillion economy and etc. But until people are not participating in that, it's not going to help. So I think you will see a lot of change happening at an industry level, and the push happening towards getting more and more people, coming into using mutual fund products. I think so. You will see a lot of change happening as you go ahead.
Well said, Vishal Jan. Clearly, I think the initiative led by SEBI and also by all stakeholders will definitely take us to those numbers and many more. Why not? I'd just like to thank you all. A heartfelt thank to each one of the panelists, I think, for their wonderful insight on each of the topic from their, even by giving examples of different, tenures, times and all, for their wealth of knowledge. As we conclude, remember that in the dynamic world of investing, it's not either or, right? It has to be a combination of the two, and clearly both embedded in the portfolio has a much bigger impact on the overall aspects of the returns or the whole inclusive growth of the portfolio. I'd like to just thank all of you. I don't think we have much time to take any more questions, which could be taken later. So for this wonderful session, thanks for participating. Thank you so much. Thanks a lot.
Thank you.
Thanks. Happy to be part of this. Thank you so much. Yeah.
Thank
Bye.
you very much.